Thank you for joining us. So today we're going to talk with Vin Biscoglio from Smartly Home Loans to provide a little more information on what you can expect if you're looking to buy a home this year. My name is MarshallOstop. I'm a real estate agent with William Ravis in West Hartford, Connecticut. This is my podcast. Hi, Vin. How are you?
I'm well. How you doing today, Paula?
Good. Thank you for joining us. We love having our clients work with you because I think you do such a great job of explaining the process to people. So I had people send in a few different questions that I'm hoping we can run through real quickly. And I think it's going to be really valuable information. So one of the first questions, which was very, very interesting, is what is the current interest rate and how is that determined? I think the how is it determined is interesting because people will see that the Fed reduces a rate and then don't see that reflected in their mortgage when they're looking to buy a home. So explain that to us a little bit.
Sure. So it's funny that you're asking that question today because we had some CPI numbers come out this morning, and that's an economic report that comes out. And it showed that there's the potential of future inflation going into place. So when it comes to mortgage rates, it's all predicated off of the spread between the 10-year treasury bond and the yield. So what ends up happening is as there's inflation pressures, it will drive up that 10-year bond and the yield, which means that the mortgage rates, because there's a spread between the two, actually increase as well. So when you hear the Fed is cutting the rate, the Fed is only cutting the short-term rate that banks borrow from other banks overnight. So whereas it's usually something that we get the most phone calls about, hey, the Fed cut the rate. I always put up on my social media stuff a picture of an apple and an orange because the two actually have nothing to do with each other. And we've seen that since September when they started cutting rates. Mortgage rates actually have only gone up since September. So, and we're going to start seeing them trend up in that direction again. So when someone asks me what the rates are right now, I would say the upper sixes and some pressure could go back into the sevens. It's all specifically going to be decided by the courts, how much of a down payment, what you're actually using the money for. Is it to purchase a home or is it to purchase an investment property? So there's some variables that go into it, but that pretty much gives you an idea.
That's very, very helpful. So along those lines, many people often ask when they start working with us, what information do they need to provide to you to determine what they can afford or what they're pre-approved for?
Okay, so when the Dodd-Frank bill came out, something that changed after the 2008 credit crisis was having the ability to repay the mortgage. Okay. So once that went into effect, we got rid of all the stated income loans, the no income loans. And what it means is now we have to verify as an industry, your income that's actually going to translate to how much you can afford. What goes into that is how long you've been on your job, how you're actually paid. Is it salary? Is it hourly? Is it variable hours? Are you paid commission? So there's underwriting guidelines that we all follow. So that's where you fill out your pre-approval application up front. It basically gives the lender the preliminary information, and then we go ahead and document to make sure that what the customer puts into the application is actually accurate information. And that will determine how much you qualify for, how much of a down payment you need, that kind of thing.
That makes sense. So over the course of the past year, what were the most common types of loans that you saw people using? I mean, is it still all everybody's doing a 30-year fixed conventional? And
I would say a majority of the time, yes. Depending on where you are in the country, and I'll talk about this now. You take a state like Florida, where it has an influx of listings coming on the market, and it seems to be kind of changing over to a buyer's market. When that happens, you have the ability for a buyer to actually use, some of the government insured programs such as FHA, BA, USDA. In a state like Connecticut, because it's just there's such a lack of inventory, most listing agents are pretty much telling their sellers, "Hey, let's take a conventional loan." And it's because they think it's easier to do a conventional loan, get it approved and get it closed quicker than say an FHA or VA, which when the appraisal is done, may actually have the appraiser mention something, with the property that needs to be fixed before they can close. That being said, it doesn't make FHA or VA worst program to use. It's just really educating the people that are making the decision on what they're going to offer. I'm sorry, accept for an offer on the property.
Right. So when you're looking at helping agents and buyers understand the benefits from a conventional loan to an FHA or a VA loan, I have these conversations often this year with sellers where they're trying to decide between a conventional loan and a VA loan. And in my experience, there hasn't been any additional challenges using a VA loan to get to closing, particularly when those buyers have been advised, even if they're doing 100% financing, they should have some money down as earnest money to show to the sellers that they're serious. What do you see on your end?
So my personal opinion, and this is especially when you have a veteran that's trying to use a benefit that they've actually earned and they've put themselves out there for a country. So why a seller would want to avoid having a veteran use their benefit, which is the VA loan. But when you have one that has money that could put a down payment down, but chooses not to, because again, it's 100% financing. There is no monthly mortgage insurance. So sometimes doing that just makes more sense for them to keep money in the bank just in case the furnace, breaks down after they close on the property. They might need to buy furniture, that kind of thing. But if you see someone actually has money that's doing 100% financing, now let's use an appraisal coming in low. Okay, on a conventional loan, someone's putting down 5%, and they're pretty much tapped out after they pay their closing costs and their 5%. You would think, well, it's conventional; they're doing 5% down. However, the way all the underwriting guidelines are written, conventional, VA, FHA, it's not based on sales price value. It's actually based off the appraised value or the sales price, whichever is lower. So in the case of the conventional loan, if they were selling for $400,000 and it came in at 380, well, that 5% down payment is $20,000. That would mean even with the $20,000 down payment, the buyer would literally be at 100% loan to value, which means that conventional loan cannot close. Now let's flip the script and go over to a VA. So if the veteran has $20,000 in the bank and the appraisal came in at 380, as long as that veteran is willing to put that $20,000 into the transaction, they are still at 100% loan to value, buying it for 400, putting 20,000 down and borrowing 380. So it actually makes it where the VA loan works in that case. The conventional loan might not work in that case.
No, that's a great example. So, another question that I get often from buyers, and this I understand is probably going to be dependent a little bit on what type of loan people choose, but what type of fees can they expect related to loans? Like people often say, is there lender's fees? Should I be buying points? And this is when we send them off to you or another trusted lender.
Yeah. So to answer your question, each lender is going to have their own set of fees. What's nice about this loan estimate that federal government came out with through the Consumer Finance Protection Bureau is it within 3 business days of someone having your information from a qualification, having an address that you're actually looking to purchase, and having your credit score, they have to actually give you in writing a loan estimate, which is going to break down different fees that are going to be charged. Now, the way it's set up is Section A is going to be the lender fees. So you'll be able to compare what Vin gave you at Smart and what ABC Mortgage Company gave you down the road. So I always tell my clients, hey, man, look at what's in Section A, because that's going to tell you everything. I've had, just in the past few weeks, I had a call with someone. They told me how they were getting charged no underwriting fee. They were getting charged no processing fee. They were getting charged no application fee because they're a first-time responder. So I said, all right, now listen, when you get that loan estimate, because they owe that to you, just do me a favor. Go to page 2, look at Section A, and then if it says 0, that is a great deal. You should go with that because it's a phenomenal interest rate for no charges. So a few hours later, I actually got a phone call from that same client, and he was perplexed. And he was perplexed because he said, "Vin, you said it should say zero." I said, "Yeah, that's exactly what it should say based on what you told me your loan officer quoted to you." And he said, "Well, how come it says $12,000?" I said, "Do me a favor, send me a picture of it, and I'll tell you." So when he actually sent it over, yes, there was no underwriting fee. Yes, there was no processing fee, and no, there was not an application fee in Section A. However, there was a $12,000 charge on a $400,000 loan, which means he was getting charged 3 points, whereas he thought he was getting paid or charged zero. So there's where the big difference is. So when you're looking at your loan estimate, just remember that Section A are the lender. Section B are charges that you're going to pay that you can't shop for, such as your credit, such as your appraisal, tax service, those kind of things that lenders actually have to get, but they're closed lists, so you don't get to choose what you're going to pay for those. And then Section C is going to be the title section in the state of Connecticut. It's an attorney state. So the lender is going to quote you an estimate on what the fees may look like from an attorney. However, you have the ability with most lenders to choose whatever attorney's law firm that you're going to work with in Connecticut and other parts of the country. It might be a title company. So that's the stuff that gets estimated for you. And ultimately, you're going to pay what that third party provider charges you. Other than that, everything else should look identical from lender to lender with your access codes, with your transfer tax, that kind of thing. So just check Section N. It's the best place to start.
That's perfect. So another common question that we get is, how long are the pre-approvals good for? And buyers are always asking, does their credit need to be run each time a pre-approval gets updated? And I think this is timely in our area because we have such limited inventory. We've got so many buyers who are searching for 6, 9, 12, sadly, sometimes even 18 months, and making multiple offers before they're successful.
So it's a great question. And I'm actually going to ask you a question back. When we're talking about a pre-approval, it means so many things, to so many different people. So what do you consider a pre-approval, Paul?
For me, I consider it a letter that's stating that this buyer has been fully underwritten. You've looked at their income, their assets, their credit score, and they are ready to go pending a signed purchase contract.
Perfect. So that's what I consider a pre-approval as well. Unfortunately, in our industry, there is no real terminology for a pre-approval. Just last week, I received a pre-approval letter from another lender. And the reason for it was I was talking to the customer, and when I had them fill out the online application, they were looking for the pre-approval letter, and then started piecemealing different documents, W-2s, pay stubs, tax returns, bank statements, asset account statements. And it wasn't all sent at the same time, and they were also missing things. So I picked up the phone and I called and I said, "Hey, when you got your pre-approval letter from this other lender, didn't you send all this documentation over at the same time? Why are you piecemealing it to me?" And the response was, they didn't ask me for any documentation. They went by what I told them over the phone. So that is more of what we call a pre-qualification letter. Okay. So that's the number one thing I forewarn people. And I literally wrote a blog post just the other day about that. But that being said, a pre-approval will continue to qualify for how much you qualify for based on your income, based on what your monthly obligations are that show up on your credit report or child support or alimony. So all that goes into it. As long as those numbers don't change, that pre-approval amount will just continue into the future. What does expire, and you brought up the credit report, well, a credit report is good for 120 days. Documents that go into your file, such as pay stubs and bank statements, those are also good for 120 days. So what I always have my clients do is update their pay stubs, update their bank statements, asset statements every 4 months, because that keeps our pre-approval in check. Now, when it comes to a credit report, what I always suggest is after we have that first one, if it expires, we just do a soft credit bar just to make sure nothing's shown up. So if you have someone that has a 780 credit score, most of the time it's stated 780 credit score, because in the past, the credit score is all about your historical data. You have someone that actually continues making the same amount of money. They typically are in a pretty good position where they're not going to get in trouble. But we do the soft credit requirement just to make sure. And then once they actually are making an offer, say on the next property, at that point, it's when we would actually go ahead and look for them to do another hard inquiry.
What are the good first time home buyer programs out there that you think people are taking advantage of or don't know about? And are there any programs that people don't think about that they should be utilizing? Not necessarily first time home buyers, but just, in general for lending options.
All right. So you have, for first time home buyers, there's going to be state bond programs that people should always look into. Take the state of Connecticut, the time zone program is out there where they're going to give you, and it changes every time they have a lot of money come out. But generally, they're going to give you X amount of dollars based on your sales price that you use towards your down payment and closing costs. So it's a great program. But outside of that, you have other first-time homebuyer programs, because when you look at Fannie Mae and you look at Freddie Mac, they'll have programs that they put into place for first-time homebuyers, where CHFA in Connecticut sets the interest rate that everyone gets the same interest rate. Well, if you look at a Fannie Mae or Freddie Mac product, they actually have the absolute best interest rates available, and they actually don't pay attention to the credit score as much, as long as you are making 100% of the median income in the county you're purchasing the home in, because then you would qualify for that first-time homebuyer program. So if you look at doing 3% down, if you're looking to invest some of your own money, which I always think is a good idea for the buyer to have skin in the game, how do we get you the absolute best terms? Well, that would be taking advantage of the Fannie or Freddie programs, where again, you're a first-time home buyer, and as long as you don't make more than 100% of the median income for the county you're buying a house in, it's going to get you the best terms. Some of the programs that are missed out with the most opportunity for people, I think of self-employed people that have been told by a bank or a mortgage company, you just don't qualify, for financing because you're self-employed. Maybe your CPA writes off an awful lot of expenses, so your income tax burden goes down. But when that happens, when we look at the ability to repay, you're self-employed, we have to look at what's on your tax return and what your net adjusted income is. If it's been depleted so much so you avoid paying income taxes, it's going to affect what you qualified for. So there are programs that are out there, and they do require 10% or greater as a down payment. But we can literally take a look at your bank statements over a 12-month period and just look at what those deposits look like. We apply an expense factor to it, and then we come up with a calculation to verify you have the ability to repay. That program is a phenomenal program for self-employed people that might have heard no in the past, just because the lenders, not all lenders do it. So you actually do need to get in touch with a lender that knows how to help self-employed buyers.
That's great information to have. Anything else we should be aware of going into this year, Vin?
I've been listening for years and years, to the talking heads on what's going to happen with mortgage rates, and they seem to always be wrong. So if I'm a consumer, I'm just making sure I'm shopping to get the best terms that I possibly can. Because again, I'll just bring this back full circle to one of the questions you asked me, and that was, wondering about closing costs and where interest rates come from. There is a spread above the 10-year treasury that makes an effective mortgage rate. But something that goes into that mortgage rate as well is each specific lender has a margin that they have to build into what you're getting offered as a consumer. So if you're dealing with a lender that has high expenses, that means the margin has to be higher, which means instead of getting a 7% interest rate, you may be quoted 7.5%. Now, if you're borrowing $400,000, $500,000, if you're borrowing $200,000 and you're paying 0.5% more than you need to, that's just, it's unneeded. It's just a higher monthly payment. So what I always suggest to people is just shop. If you're listening to, your realtor who's referring you to a lender, it's always worth getting a second opinion. I always tell people, look, talk to 2 or 3 people, use it as a barometer. So you should know, pretty much where rates are. So just save yourself some money by doing some shopping.
Absolutely. Vin, as always, an absolute pleasure, always helpful. Thank you so much. And I hope everybody will tune in next time. And until then, happy house hunting.